Here we are now looking at the 2016 cash budget question, part two. We're going to examine how to do part C and D of said question, which are the cash budgeting parts, rather than in part one we looked at the production budgeting elements. So some of this is going to be very reminiscent of cash budgeting as a standard topic or a standard question. For example, in the cash sales, credit sales, and credit sales for 2 months, we must read paragraph 4 of the question 2016, which says the cash collection pattern from sales is expected to be as follows. Cash collection is 30% for immediate cash, and then 70% is on credit, and half of that is 1 month later, and the remainder is a second month later. So if we take the July sales revenue of 270,000, if we multiply that by 30%, we will get 81,000. And if we multiply that by 70%, but then whatever that answer is, you divide by 2 because it's half 1 month and half the next month, and that number there is going to be, when you divide it in 2, it's going to be 94,500. So therefore, how do we represent that in our cash budget table? Well, July sales, in the month of July, we collect 81,000, but then we have to wait 1 month for 94.5, and we have to wait 2 months for the other 94.5. And that is the figures based on July sales. You do the exact same process, but with August sales of 292,500. So therefore, what is 30% of that? You're going to get 87,750. And then you have got 102,375, and again 102,375. And then you base it on September sales, and September sales are 33,000, so 30% of that is 99. And then the 70%, half of that is 115,500, which we will collect in October. The other half of that we do not collect until November, which is outside of our time frame here. And then October sales, well, the 30% is 108,000, but then we'll collect the 70%, half in November, half in December, again, both outside of our time frames. So therefore, that is how we do our cash collection, our debtors, and indeed our cash sale. Then we'll have a look at our purchases. Now, paragraph number 5 in the question talks to us about suppliers, and it says 1 month's credit is received from suppliers. We've done all the hard work here already, because in part B of the question, we've worked out how much we are buying in each month. All we have to do here is say that we're going to pay for it in the following month. So what we buy in July, we will pay for in August, 203,400. And what we buy in August, we will pay for in September, 128,640. And what we buy in September, we will pay for in October, 140,880. And again, what we buy in October, we will not pay for until after this cash budget is finished. Now let's look at the wages for a moment. The wages here are a little bit tricky. What you have to do, it says in the question that wages are 10,000 euro plus 5% of sales revenue for every month, payable as incurred, so in the month. So what are the sales revenue? What is the sales revenue for July? It's 270,000. If we do 5% of that, that's going to be 13,500. But we also have a basic wage of 10,000 to pay, so therefore that's actually going to be 23,500. for our wages here. Now, the same process will apply in each month. So in August, it is going to be 292,500 by 5%. You get 14,625. But of course, then you have to add on the 10,000. It's actually 24 in this case. Check these in your calculator. And then 26,500. And then you have 28,000. Now, the variable overhead per unit. Well, it says in the question that the variable overhead is €4 per unit. I've just made a note of that here, €4 per unit variable overhead. What units are they discussing here? Well, you need to go all the way back to the top of the question. The answer to part A, these units here, and we're just going to multiply those by €4 per unit. So 14,850 by 4 is going to give you 59,400. That's the amount. They reckon that €4 per unit covers their electricity, it covers their heating and cleaning and maintenance and all these variable overheads that they will have. 46,400 here and 49,200 here. Now the fixed overheads will take a little bit of work. Let me just get a bit of space here. It says that the fixed overheads are 28,000, but that includes depreciation. Now, depreciation, of course, is a non-cash expense, so therefore it should not be included in the cash budget. So we need to remove that from the 28,000. Now, how are we going to do that? Well, we have to work out what the depreciation is on. Look at the capital cost section on paragraph 6. It says equipment will be purchased in July costing 60,000 and it will have a useful life of 5 years. Well, that means if you divide that 60,000 by 5 years, that will give you how much it depreciates per annum. And then if you divide it by 12, it'll get you how much it depreciates per month. Of course, 6 years is 60 months. So therefore, it's actually 1,000 per month in a year. And that is our depreciation. So if we remove that bit from our fixed overheads, then the remaining fixed overheads, which actually are cash, are 27,000. We can replicate that across. The equipment itself was bought in July, so you just put that 60,000 in there. But now it's going to talk a little bit about the loan. Now let's talk about the loan for a moment. It says to finance this purchase, a loan of 48,000 will be secured. Now that loan actually needs to go down here, that 48,000. So I'm going to include it down here to begin with. I've automated this up and down, open and closing cash, because I think at this stage, if you've done cash budgeting, you're comfortable with how to do that. So let's look at the loan part. It says this loan and interest will be repaid over 4 years. It'll have a 10% per annum interest rate, and the capital and the interest payments will commence in August. So therefore, in the second month here. So if it's 48,000 and we're repaying it monthly over 4 years, that is 48 months, which again, coincidentally, no correlation between the two, is €1,000 per month as well. And that is paying off 1,000 in August and September and October. 3,000 now will come off the loan in a balance sheet if we were doing a balance sheet. The loan interest itself, well, that is 48,000 by 10%. And if we want to find out how much that is per month, we would divide it by 12, or as I sometimes do here, multiply by 1/12. And that will get you €400 per month. And that's going to, again, happen from August. You're not told in this question that the interest is going to be reducing accordingly when the loan is being reduced. If you were told that, then you would have to recalculate, and we have done that before. But here, according to the Department of Education marking scheme, it's €400 per month, so it's on the entire amount, fixed amount of interest. Then, as we've done many times before, you take your expenses away from your incomes here and you're going to get your net cash. We have no opening cash, of course, because it is a new company being set up. So therefore, you have your bank loan and then you get your closing cash and you work up and down until you get 11,745 of a negative in both places. Now we're going to move on to part D, and a lot of this hopefully will be straightforward for us. Part D of the question, well, first off, the sales we get by adding up the 4 months, July, August, September, and October, the 4 months from the question's sales. So that is 270, 292, 500, 330, and 360 gives us this number here. So the total of the 4 months from the question. Our opening stock is 0 because we do not have any opening stock. It's a new company. This purchases is the answer to part B of the question. So I'm just going to bring it back up here. I had that highlighted in green. Do you see this part B here? That is the purchases. And then I want you to be very careful about your closing stock. Do you remember these two closing stocks? Let me show them to you again. This is at the end of October. Your closing stock of finished goods is 7,500 units, and your closing stock of raw materials is 7,608 kilos. Well, that is the closing stock numbers that we're going to have down here, and I've still kept them in yellow to keep our color scheme. But that is 7,500 finished goods by 20, which you were given in part D of the question, and 7,608 kilos by €4 per kilo, which you were given in paragraph 1 of the question. We've already used that. And you get both closing stocks and you subtract them to get your cost of goods, cost of sales, and from that you get your gross profit. All right. Now, then you have we have no gains in this question, but we do have some expenses. The depreciation, well, we know that the depreciation was 1,000 per month, and of course, we're doing this for 4 months, so therefore that's how you get that. The fixed overheads, well, the fixed overheads, I'm just going to bring you back up here slightly to get the fixed overheads. We do it like this. So the fixed overheads are going to be this 108,000. The variable overheads are going to be this 197,000. The interest is going to be this 1,200, and the wages are going to be this 102,625. So all of those numbers are directly from the cash budget in part C. 108, 197, 1,200, 102. You take away those expenses to get your net, and that's your net profit of 398,675. There is also a little bit of theory here, which I'm going to let you guys look up in your theory handout, but there's the answer on your screen. I'm going to stop the video at this. Thank you very much for watching.